Over recent years, share markets have been on a turbulent journey, with valuations soaring and then returning to earth. This week, we dig into the data to answer the important question, are we there yet? Hosted by Stefan Clark, Chief Client Officer, and Andrew Curtayne, Portfolio Manager, this week's Monday Call is a great opportunity to gain valuable insights on markets and investing. We'll explore a range of topics, including whether shares are now cheap by historical standards, the long-term returns of different asset classes, how company earnings have changed over time, and how long bear markets typically last. We'll also be comparing markets in the US, Europe, Australia, New Zealand, and China, and examining the long-term returns that investors in these markets have seen. Supporting slides for this call can be found at nzfunds.co.nz/insights. This is the Monday Call, brought to you by NZ Funds.
All right, well, without further ado, Andrew, welcome. It's great to have you here. Let's kick off with, what do we mean by are we there yet? What are you thinking when you think about that?
Thank you, Stefan, and good morning, everyone. The simple answer to that question is people generally want to know, is the bear market finished yet? So are we at a level where we can start a new period of compounding returns, such as what we often see in the share market, where it makes nice steady returns in that sort of 7 to 8% level over a sustained period of time. Now, as we know, share markets are broken by periods of negative returns, which is what we call the bear market. Now, the question that we're trying to answer is, now that we're 15 months into this period of sort of downward sloping share market returns, are we at a point where the market may find a bottom and may start to compound in positive returns again?
Okay, and so let's, first question is, why do prices even change? What is it that it's happening, and why is it that, from 15 months ago, things were looking rosy and the world seemed to be going up, and now things aren't? What is it that causes, at a fundamental level, prices to start moving?
Well, let's remember the share market is actually investing in real assets, being companies. Any index, such as the NZX 50, is comprised of 50 companies. All these companies are their own businesses, which are earning revenues and profits. And the index movement or the index price that moves is really the movement in the individual stock prices of all those companies that comprise that index. Now, what moves a company's stock price? Well, it's a whole host of reasons, but some of the main ones are, how is that company performing? Is its earnings increasing or decreasing? What are the future-looking prospects of the company looking like? Is it expected to accelerate its level of earnings increase in the future, or maybe to slow down the level of its earnings growth? Also, more macroeconomic factors, such as what is happening with interest rates. When interest rates are increasing, it tends to be negative for the share price of companies. We could be looking at other external factors, such as, is the global economy looking at more risk? Are we expecting a recession to come forward? Is there a war going on, such as like we've had with the Ukraine war? How does that impact companies? So it's really a whole host of reasons. Now, we sort of look at what's going on at the moment. Why has the stock market sort of been in a slightly downward sloping trajectory over the last 15 months? Well, that's been a couple of reasons, but right at the top of the list is increasing interest rates and a reduction of liquidity in the global monetary system, which has been come on due to the high inflation levels. And this has caused central banks to try to control that inflation by increasing interest rates and really trying to slow down the speed or the amount of money that's flowing through the system. So in the same way that your housing prices tend to fall when mortgage rates go up, company share prices tend to fall when interest rates increase quickly over a short period of time.
Righto, and so obviously there's a large number of factors that get taken into account by investors. People talk about investors being forward-looking and trying to understand information into the future and bring that into the price. Well, how do you think about that? Because obviously there's today's information that we know, and then there's expectations. As a portfolio manager, how do you think about, well, the prices, what it is, and I know that now, but obviously I have to take a view on where it's going.
Yeah, so at its simplest, fundamentally, a company's valuation is the discounted cash flow of its future expected earnings, or we call this a DCF in the finance world, which is essentially where you model forward exactly how much money a company is going to generate in each year, and then you discount that back based on the average cost of capital for the company. But let's say we're looking at a company's earnings over the next 20 years. Well, really we are forward looking then, because we're wanting to know what this company is going to earn next year, the year after, and potentially what the company is going to earn in 10 and 20 years time. Now, obviously, the longer you forecast that out, the more unpredictable it becomes. But if you look at the next couple of years, we do have a little bit of an idea of what might be happening. We know there might be a heightened chance of a recession happening next year, and therefore in a recession, you tend to see things such as property values go down. You tend to see consumer spending decrease. You tend to see building activity decrease. So you might say, if we think there's a heightened chance of a recession in the next 12 to 24 months, then we think the valuations of company exposed to the building sector and consumer spending will go down. On the flip side, you might take have that same sort of recession view, but then say, look, we'd rather own companies that are exposed to utility type sectors or infrastructure sectors, which tend to hold up better in those sectors. So in answer to your question, Stefan, that's really what we're thinking about as investors when you say, look, we're forward looking. We're trying to understand what the world is going to look like in the next couple of years, and what that company's prospects are based on that view. And also, just to bring it back to the longer term, we're also still trying to think 10 to 20 years out. We don't completely base our investment decisions just on what might happen next year, because in the end, we want to own great companies that have a proven record of compounding growth or growing earnings over 10 and 20-year timeframes. And just because a company may see some pressure 1 year out, it doesn't mean it's a bad company. It doesn't necessarily mean it's a bad investment if it's going to continue to grow really well over the next 10 and 20 years.
Fantastic. So if we think then about, and we're going to talk about returns and earnings in a little more detail as we sort of launch into some of the data in time, but you mentioned the long term. So I'm aware that there's a book by a professor of Wharton School called Jeremy Siegel, who wrote Stocks for the Long Run. It's sort of it's a famous book within the finance industry, and he, in that book, does a deep study into long-term returns of different asset classes, and that and particularly what he concludes through it is that the real return of shares is roughly 7%. So that's after inflation. Before inflation, it's something like 10%. Of bonds, it's 3.5%, and of term deposits or treasury bills, as they call them in the States, it's 2.5%. And as part of that study, he effectively shows that the purchasing power of shares, when you're invested in shares, doubles every 10 years, but you need to hold on. So, how does, I know that you think about, his work and when you're investing and you explore you explore the returns profile of the long backwards looking data that he's looked at. How does that feed into when you're looking forward and choosing businesses to invest in or constructing a portfolio for clients?
It's great that you mentioned Jeremy Siegel and the analysis he's done, because it's a great book to remind you of why the share market or stocks is such a fantastic investment class. So Siegel's looked at over 200 years of data going right the way back to the early 1800s of what the share market has done and other asset classes and what their returns have been over that period. And as Stefan mentioned, the real return in shares is about 7%. So if you add inflation to that, you're earning somewhere between 8 to 10% a year over a 200-year period. And if you break it down into smaller 30-year or 25-year segments, you tend to get similar returns as well. Now, what we take from that as long-term investors is that our job is to, in general, keep our investors or our clients invested in the share market to earn these long-term returns. If you stay in the share market over a 20 to 30-year period, history will tell you will earn these returns, and that's sort of 7, 8, 9, 10% return from the share market. There's no other asset class you can invest in which earns those returns. The closest that comes to is property, which Stefan or Noah might touch on in a bit, but that is the main premise of what we're trying to do. So yes, we'll be looking at times about what might be happening this year and what might be happening next year. And if we're particularly concerned about the valuation of stocks, we might be reducing our exposure a little bit, but we're not trying to flip into the market, flip back out of the market, trying to invest for the next 3 months or the next 6 months, because we need to stay still invested to make sure we earn those sort of great sort of 7 to 9% long-term returns.
At one point, I believe in the book, he identifies that there's never been a 20-year period for stocks where the real returns are negative. So after inflation, you're still getting a positive return, even so long as you hold them. That's on an annualized basis, so long as you hold them for 20 years, which sounds like a very long period of time, but most of the periods don't require that. And that's looking back, I think, what was it, 220 years? And so it goes through the Great Depression, the Second World War, periods of high inflation, dot-com bust, the GFC, all of those. And he concludes in that equity returns, as long as you stay the course, have shown astonishing stability.
And that even includes, you mentioned the Great Depression, where it was the greatest share market fall in the United States, and the market fell by over 80%. But even if you had been unlucky enough to invest just before that 80% correction in the share market, if you held for 15 to 20 years, you were still back at positive returns. And if you held for another 15 to 20 years, you were back at a great level of compounding returns.
Yeah, which is incredible, really, when you think about it. And then maybe we do just jump into the other asset classes briefly. But property, for example, in his book, he talks to the fact that property also produces similar returns, but it has a lot of unique profiles to it. It's hard to liquidate if you want to exit, and transact on it. There's a lot of management involved in it, and there's other idiosyncratic elements to property. But correct me if I'm wrong, Andrew, but my understanding is that property and shares or stocks, as he calls them, produce pretty much similar returns if you hold them for similar periods.
Over the last 40 to 50 years, that's been the case. However, the data for property returns before then gets a little bit more tricky, because obviously if you own property, you need to be accounting for the rent you earn in each year. So the data gets, so if you look in the early half of the 1900s, it gets a little bit trickier. And also the thing I'd point out with property over the last 40 years, it's been a very large beneficiary of lower interest rates. Interest rates peaked in the 1980s, or the last peak we had, and there's sort of been decreasing in general since then, which has helped drive higher property returns that you would probably normally expect in a period of flat interest rates.
Okay, so let's launch into the slides. If we move through, there's a couple here. There's obviously a lot of slides in the slide deck, but there's a couple that are really quite powerful. Would you mind talking first off about the S&P 500 5-year annualized return? A mouthful, but it's quite an important piece of information. And
just to provide context, we often in these calls talk about the United States market and the S&P 500. However, we're based in New Zealand, so you might ask why do we focus so much on the United States market? Well, United States is over 50% of the listed market capitalization of the share market globally. This has floated from sort of levels of sort of down to 30% at some points, up to about 60% plus at some points. So it is a huge component of the global market. And two, at New Zealand Funds, we invest in most developed markets around the world. We invest in New Zealand and Australia as core allocations to our investments, but United States is also a core allocation. We invest in Europe, we invest in Asia. So we really take a global approach and diversify around many share markets rather than concentrating risk in one share market. And we might talk a little bit further on that in a second. So yes, the five-year returns, this is a chart that we quite like to look at this annualized level of 5-year returns, because it provides a smoothing element of what you expect if you stay invested for the medium to long term in the share market. If you look at 1-year returns, the market could be up or down 20% in a given year, but over the 5-year period, you will see that you tend to earn positive returns if you hold your shares for 5 years. So I guess there's a couple of key messages I want here. The first is that if you look at where the 5-year return turns negative, there's only been a few periods in history going back over the last 100 years where we've seen that happen. The second thing I would like to say is that we've also had periods of outstanding returns in the sort of 10 to 20% level for a sustained period of time. In particular, one of the greatest periods for share market returns in the United States was the period of the 1980s through to 2000, where we were earning returns in the 10 to 20% level for almost 2 decades. But there was a period also that we've been through recently from 2009, 2010 through 2020. We earned a great period of sort of 10 to 15% annualized returns for about a decade.
And that coincides with the interest rate decline you were talking about.
Absolutely. So it was both cheap valuations. The valuation of the market got very cheap post the financial crisis. And we also had a period where the monetary policy was very accommodative and interest rates were coming lower, which drove a fantastic period of both economic growth in the United States, earnings growth of companies, and great share market returns.
Fantastic. And how does that translate? We've also got a chart of the 10-year annualized return, which is very similar, but different too. Would you compare the two?
Yeah, so 10-year, what we're doing on the 10-year is we're doing the average annual return over the last 10 years. So it's a longer time frame than the 5-year period. What you'll notice here that there's only been 3 periods in the last 100 years where we've had negative returns, which was around the Great Depression in the 1930s. We're slightly dipped negative in the 1970s, where we had the inflation situation in the United States, also other factors such as the Vietnam War and a number of external factors going on. And then the financial crisis, we had a period of only a small period of negative 10-year returns around 2008 and 2009. But from the upside level, we tend to peak around 15% annualized returns over the last 10 years, which was seen 3 key periods where that's been achieved, which was the 1950s, late 1990s, and then also we've almost just touched on it in the last couple of years where we had this great 10-year period since 2010.
So in each of those periods where there were negative returns experienced, subsequently it obviously rose again, and then in each case it drove higher and higher. Is that what we can take from that data? Yeah,
it's these shares are a cyclical market. The economy is cyclical. Nothing is extrapolated into future. The periods where you have these negative returns, I know the sentiment tends to get quite negative in the market, and people kind of get downbeat and say, "Look, we've had a period of 5 years of returns that haven't been very high or have been slightly negative." But if you look at this chart throughout history, and for those that are listening to the call, I encourage you to download the slides and have a look. You will see that this never lasts forever, and sometimes the returns bounce back very fast, such as they did in 2010. And then all of a sudden you're in a period of fantastic returns and getting 10% per year.
Right. The next one is this concept of enterprise value, so to EBITDA multiple. So this is still in the American market. We're talking about the S&P 500. We're going to be using this term a little bit as we move across to other markets as well. Tell me, what is enterprise value to EBITDA multiple? What is? I mean, it's a mouthful. What does it mean, and what are you trying to show with this chart?
Enterprise value is another way of looking at the total value of a company. So the one that most non-finance professional people would be used to is the market capitalization, which people talk about. We actually look at a slightly different term called the enterprise value. Now, all the enterprise value is you take the market cap of a company and you add back its debt that it holds. So what you're really looking at is you're looking at the total value of the company, including the value that it has raised from debt holders. Now, what this does is it sort of normalizes for how leveraged companies are. And if I give an example, you might have a company which has a market capitalization of $1 billion and it has $200 million of loans from the bank. We would be looking at the total value at $1.2 billion rather than $1 billion. Now, we compare this to a term called EBITDA, which is earnings before interest, tax, depreciation, and amortization. Now, rather than go through all those points of thing, just think of EBITDA as being a slightly more stable version of earnings, which is really focusing on exactly what is the company generating from its assets or its operations. You know, a company selling a product and it's got a cost to produce that product. That's really what we're looking at, and it also includes all the kind of call it the overhead costs of paying the people in the office and its general sort of general administration costs, but it excludes your financing cost and the depreciation on your assets. Now this multiple is a very key multiple that is tracked by all investors, both on an individual company basis and when you look at the valuations of entire indices. The first chart we've got up here is looking at the S&P 500, which is the 500 largest listed companies in the United States, and we're tracking this multiples all the way back to 1992. As you can see, for those that are looking at the chart, the average multiple has been 11.6 times over this last 30-year period. At the moment, we're sitting at about 13 times. So we're sitting slightly above that average valuation level, but we're in the range which is sort of considered more normal. What does this really mean? It means from this level, all else equal, we should be at a level that can earn that sort of 7% real returns or the 9% nominal type returns you expect from the share market. It also is telling us that we've come back to a more reasonable level, because only a year or two ago we were trading at sort of the upper 18, 19 times multiple, which is a level which was very expensive. And a level that you sort of would have been a little bit nervous about the prospects for the next returns in the next couple of years. Since then, we've had the share market come back by over 20%. The underlying earnings of the companies have continued to grow. That's why that ratio of enterprise value to EBITDA has come back to 13 times. So we're at the level where we want to be invested. We'd be very nervous to be saying we're going to have very high cash levels when you've got valuations that are sitting around about the long-term averages.
Righto, and on the chart, you've got these lines drawn and first standard deviation on either side. That's telling you, how do you think about the standard deviations with earnings?
So this is the standard deviation on the multiple, and what it's saying is, are we within one standard deviation above or below the historical level? And at 13 times, we're actually below the one standard deviation level. So, it's again saying we're not really at a level which is unusually expensive. If we're heading above that standard deviation level, we'd be a little bit more cautious and maybe looking to have a little bit more protection in the portfolios in case those valuations came back to the average level.
Fantastic. And so I guess what we can conclude from this is, to the extent of the 500 largest companies in the States, which obviously makes up a big part of the global economy, valuations on using this multiple are close to fair value compared with historical averages.
That's right.
On the next chart, we have another similar multiple, but it's used in a different way. This is the price to earnings multiple, again on the S&P 500. Would talk us through that and how that's faring compared with historical averages.
Yeah, so the price to earnings multiple, or the PE multiple as it's known for short, is probably the most talked about multiple you hear when you look at the share market. It is simply the market capitalization of a company divided by its earnings. Or in this instance, the PE stands for the share price divided by the earnings per share. You get to the same result. The difference between this and the enterprise value to EBITDA multiple is that it includes, the earnings number includes the interest cost on the debt that the company's raised, as well as the depreciation. It tends to be a slightly more variable number. It jumps around a little bit more, but also still a very relevant metric for looking at the valuations of companies. So the chart we have up here tracks this price to earnings multiple right back to 1992. It's showing that we're currently sitting around about bang on that 30-year average of around about 19 times. So again, it's reinforcing the view that we've come back to a more normal level of valuation for the market. We've also included what the market is expecting this multiple to move to over the next 2 years, which is dropping from 19 times to 18 times next year, and then to 16 times the year after. Now the reason this multiple is dropping is because the market is expecting the earnings of the company to grow. So if the earnings of the company grows, the multiple gets cheaper.
On the next chart, we have earnings per share through time back to 1954, and it is a log chart, but it keeps grinding up. Could you mind, in spite of obviously a number of events happening through that time, take us through what we're seeing here?
Yeah, so this is a chart we really like to look at. So, as I said, company valuation really depends on the future expected earnings of the businesses you're valuing. If you go back through years and years of data, you can see that earnings of companies tend to have periods of where they're growing faster than their normal rate, and then periods where they're either falling or growing at a slower level. And so what we've done on this chart is tracked this earnings level right the way back to 1950. I think it shows a really good, it shows pictorially very well when these companies over-earn and when they under-earn. Now, what tends to happen is companies don't go through periods of earning higher than normal earnings forever. The economy might change and the economy might go into a recession and the earnings suffer for a period. I just want to highlight a couple of periods here. If you look at the period sort of just after 2000 through to 2007 was probably the best period of earnings growth, which was heading into the just before the financial crisis. But we had lower interest rates. The US economy started growing at a very fast rate. Companies have been financed very well, so able to expand and grow earnings. And so we had a great period of earnings growth there, which then was followed by the financial crisis, which was a period of lower or negative earnings growth for a couple of years. But really, since then, we've been growing around about the trend level, except for the period of 2021 and early 2022, where we had a great period of earnings expansion, which is completely related or mostly related to the COVID-19 response. So what really happened there is we've talked about on some of our previous calls, is you had a lowering of interest rates and easing of monetary policy, which allowed companies to fund themselves with cheap debt and expand. At the same time, companies were able to push up prices of their products as everyone had access to cheap debt, including myself and Stefan and people at home. We were able to remortgage houses and spend money, so we were demanding products. This allowed companies to sell a lot of products at high prices while they didn't really have the cost base of their companies going up for a start. So if your revenue's going up but your costs aren't changing, you're going to grow your earnings. And that's really what happened in 2021. We're now starting to see a little bit of a reversal of that. So what we're conscious of as investors at NZ Funds is that we've had a great period of earnings. However, it's looking like we may have a period of slightly lower than not expected earnings over the next year or two. And so we're just being conscious of that when we look at our valuation of the market. So if the earnings growth slows down and comes back a little bit, that might be reason for people just to be a little bit more cautious when they're looking at the valuation multiples of these of any market, but in particular the United States.
At the same time, if you look from 1954 up to now, it's gone, earnings per share has grown from roughly 5 cents, I take it, all the way up to, or $5 up to $220, $23, which over, just goes to show the incredible process of capitalism and the American economy just grinding higher and higher, which underpins the valuations within share markets.
That's a really good point, Stefan. And we, again, coming back to invest in real companies that have great growth, and the indices around the world are comprised of the largest and most successful companies in any economy. They tend to grow their earnings faster than the global domestic product growth of any company or the GDP growth. And that's why you get these great compounded returns over long time horizons.
And the next chart compares the S&P 500, so the American economy or listed economy, to the world. How is America an outlier here, or what are we seeing?
Yeah, this is the chart we like to look at when we're thinking about our global allocation between respective markets. So at NZ Funds, as I said, we invest in all global markets, but we tend to focus on the key developed economies such as US, United States, Australia, New Zealand, and Europe, and also some into Asia. So when we're looking at how different markets have been performing each other, we take the index price of a key index, and in this one, it's the S&P 500, and we compare it to the MSCI Global World Index price. Now, what the chart was showing here is that over the last 10 years, has been a fantastic period for United States companies. The S&P 500 has outperformed almost by about 50% over a 10-year period. Although we're seeing some signs now that that's starting to reverse a bit, and we have seen, in general, slightly larger stock price declines in the United States than the rest of the world. But if we step back, why has the US performed so well over the last 10 years? Well, one reason is it's been a fantastic period for economic growth in the US. US has grown at a very strong rate. A second one is US has got some amazing technology companies, such as the names we're all familiar with, like Apple, Amazon, Microsoft, Google, Facebook, even Tesla more recently, which have been performing very successfully. Earnings have been growing at very high levels. They've been driving the S&P 500 index price higher and doing that at a faster rate than the rest of the world.
But it's not just the US that's been grinding higher. If we move forward, you'll see the NZX 50. And this is an impressive looking chart from 2001 through to 2023. And it keeps going up. Can you take us through what we're seeing here and what an incredible looking curve it is?
Yeah, so if you'd bought New Zealand stocks in 2001 by the NZX 50 and held them through to today, you would have made approximately 6 times your money in a period of 20 years. If you timed it even better and bought the stocks in 2009, just at the bottom of the financial crisis, now that's easier said than done to pick the exact bottom, but if you'd managed to do that, you almost would have made again about a 6 times return in only a period of 11, 12 years. So this has been a fantastic decade for performance of New Zealand companies. What has been driving that? Well, one, our economy in general has been performing quite well over this period. We've had a period where unemployment levels have moved lower. We've had a period where growth, overall economic growth has been good. The country has had population growth, people moving in. Property growth has been going very well.
Strong milk prices.
The dairy sectors in general has gone quite well. But also we've had some great companies. We've had a number of businesses that have grown to very large $10 billion market caps. 2 of the names that spring to mind that have done very well over the last 10 years is Fisher & Paykel Healthcare, and A2 Milk, and those 2 companies alone are actually responsible for a great amount of the performance of the NZX 50. But outside of that, we've also got some great stable business, such as the businesses in our utility sectors, the Mercuries and the Meridians, companies like Auckland Airport, which have been expanding and growing at good compounding levels over the last 10 years as well.
Righto, and so that has translated to annualized earnings. If we compare the annualized earnings to the US, how is that done on a 5-year basis?
Yeah, so we've been, actually this chart here is focusing on a smaller period than we saw for the US. We're just looking from 2006 through to 2022, but you can see very clearly there that from 2013 through to 2021, you're expected to make about a 15% annualized return for holding New Zealand shares, and you had that for a sustained period of about 8 years. So what's that? It's made about 13 years worth of returns in that level, which is fantastic. Even if you'd held New Zealand shares throughout the financial crisis period, the worst your 5-year return would have got to was negative 4% annualized over 5 years. That was the worst it got to. If you'd held it through by the time you got to 2013, you're annualizing back at a 15% returns. So again, I guess we're trying to give this message of I know when it's in these bear markets, things look very negative, but the data shows that if you can hold your shares throughout these periods, it tends to be sort of 5 years or 10 years down the track, you're right back on these kind of 10% type annualized returns.
Right, and so that's telling you that once you come out of it, there's suddenly an uptick in activity after it, and then that looking at this chart here, you can see in 2012 the 5-year annualized returns suddenly move up between 12 and 13 and 14, back up to 15%.
That's right, and even if you look now, we've had a period almost 2 years where the NZX 50 has not performed that well. The NZX 50 peaked in about early to mid 2021, but even now the 5-year annualized return is still 7.3%, and that's after we've been through a period of negative returns in the last 18 months.
On the next chart, you can see the enterprise value, which we talked a little about, to EBITDA multiple. How does this compare with the US? And it does look like quite a different chart.
Yeah, so our enterprise value to EBITDA multiple is a little bit more expensive than the United States. We're at 15.7 times, well, certainly relative to its 10-year average. Its 20-year average. So we're trading at about 16 times. The average is about 11 times for New Zealand stocks over the last 20 years. So there is a 5 times premium. That makes us, a little bit more cautious. On the other hand, we're understanding why these numbers are a little bit higher, and a lot of the reason for that is that New Zealand has quite defensive and stable type companies, which investors tend to want to pay a premium valuation for when you're a little bit concerned about the outlook. So, what are some of the risks we're facing at the moment? Higher interest rates, inflation still running a little bit high, even though it's starting to come back. We're looking at potentials for recessions coming over the next 12 months. Property prices are starting to fall in New Zealand. Building activity is starting to slow down. So we're not really wanting to own what we call sort of cyclical companies that are a little bit more risky and exposed to this. We want to own nice defensive companies. What does New Zealand have a lot of? Great defensive companies. Again, I mentioned Meridian, Mercury, Contact Energy. These are the gentailer businesses that produce and sell energy. We have companies like Chorus and Spark and Auckland Airport, which are core infrastructure type businesses for New Zealand. People will not stop spending on these products or the services that these companies provide just because we're going through a small recession. And so that is part of the reason that New Zealand NZX is holding up a little bit better at the moment with slightly higher valuations because of the type of these businesses.
And their ability to respond to the current market environment.
Yes, that's right. And we have seen some of our businesses have been very successful over the last decade come back a little bit. A2 Milk and Fisher & Paykel Healthcare over the last sort of 18 or 24 months have been underperformers, but we're offsetting that with relatively strong performance from these other businesses I mentioned.
And they can, in an inflationary environment, for example, they can pass on costs more easily than, say, a Tesla can or a Amazon. People don't want to turn the power off, for example.
That's exactly right.
Great. And so just rounding out the NZX, price to earnings multiple, it looks also quite different from the States. Take us through that.
Yeah, again, slightly more expensive than the United States. I think similar reasons due to the composition of the companies. However, we're seeing on a price to earnings multiple, we're only just above the average level in New Zealand, so that's starting to look a lot more reasonable. It could come back a little bit more, but what I sort of expect here is that we're going to continue to achieve earnings growth as a whole in the NZX 50. And over the next sort of 12 to 18 months, we'll see that come back towards that average level. And what does that mean? We're at the average valuation. I think New Zealand as a whole, even though we may have some challenges over the next 12 months with the high interest rates and housing prices, I think we're still well positioned from an economic sense. And I don't see a reason why the NZX 50 cannot continue to achieve strong compounding returns over the next 10 and 20 years.
And so if we can compare New Zealand to the rest of the world, we did the same with the States. How have we gone over the last 20 odd years?
Yeah, similar to the States, we've really outperformed in general versus the rest of the world. But really, the difference in New Zealand, we can actually say we've been doing that since 2000. Since the year 2000, we've basically continued ground outperformance against the rest of the world. And I think that's a reflection, again, of a country that has been growing well and has actually achieved or produced a number of exciting businesses which have managed to achieve great earnings growth over that period.
Very good. Okay, so if we move forward, we move on to the charts for China, and one of New Zealand's, if not the largest trading partner, it's the second largest trading partner, isn't it? How has China gone over the period? Take us through its stock exchange and listed companies.
Well, the first thing I'd say about China is it's volatile. It's a much more volatile market than we see in New Zealand and the United States and Europe. And I guess there's a couple of reasons for that. One, it is still a developing nation. And for much of this period of the charts we're showing back to 2000, it was certainly an early stage developing nation. That means it comes with higher risks. That means the companies themselves may be less established, and you may get more companies that end up not performing well and get removed from indices. But you also get some companies which grow incredibly fast, such as a company like Alibaba, and achieve great growth. The other thing I'd comment is China, throughout a lot of its the last 20 years, has still been quite exposed to the commodity market and what's been going on with overall economic growth and trade partners, and it's tended to cause a little bit more boom-bust performance in its share market. But the final thing I'd say is that what what really surprises me every time I look at this chart is currently when you look at China, its share price is no better than where it was back in 2007, 2008. So the share market in China had a peak just before the financial crisis, and that was driven by a fantastic period of growth for China. And also, they benefited a lot from sort of high commodity prices, and a lot of the products they were producing were in high demand globally. Since then, we all know China's continued a great pathway. You just look at that business and its influence, look at that country, and look at its influence on the world and its rising technology sector and the sophistication. Everything about the country as a whole has continued to improve. Yet the Chinese company share market has not improved so much. So what does that mean? In our opinion, we think the country or the share market does have the potential for good, strong future returns. It is looking cheaper. We do think the prospects of earnings growth for many of the companies there is strong, and so for us, it's an interesting place to be looking at now. While we're a little bit more worried about markets such as the United States, maybe we can move some more money to China and benefit from potentially a good period of returns in that market.
Well, since 2007, 2008, they've probably, I don't know the exact number, but it would be roughly 5 to 8% annualized economic growth, so the economy would have roughly doubled in that time. And then yet you have a stock market where the price is still below that 2008 number, which is incredible, really, isn't it?
Yes, that's right.
So if we move forward, then you mentioned valuations. Tell us about the EBITDA, enterprise value to EBITDA multiple in China. And what
might just skip to the price to earnings one for China. It's the EBITDA numbers can be a little bit more volatile. So in China anyway. So I wanted to look at the price to earnings multiple. So over this I think the thing that jumps out to me is that we've had a sustained period of relatively low price to earnings multiples. At the moment, China's trading around about a 14.5 times multiple. It's slightly under its 15 to 16 year average. And I think that's part of the reason we haven't seen this sort of sustained strong share market returns over the last decade in China that we have seen in New Zealand and the United States. In our opinion, as China becomes a more developed nation, it becomes a safer place to invest. From a regulatory standpoint, things become a little bit tighter, which means there's more protections over the money that you're putting into the country. That price to earnings multiple should move higher towards what you expect to see in the United States or New Zealand multiples. So at the moment, we're around about 5 times below where we see in other developed markets. If you think the country itself is generally growing quite fast from a GDP perspective, and also there's some great companies both in more traditional senses such as banking and industrial type sectors, but also the companies they have in the property sector, which is starting to improve at the moment, and particularly in the technology sector where we've got kind of the Amazon of Asia and Alibaba, got other great companies like Tencent and JD.com. We would expect to see a PE multiple expansion at some point. And so maybe we'll get into a level situation now where people sort of maybe looking to move money away from other developed markets. I think China can be a strong beneficiary of this.
Fantastic. So we've also got a whole bunch of charts in here around Europe. Is there anything particular that you want to highlight about Europe that stands out to you when you think it through?
Yeah, so Europe has been a disappointing stock market over the last really 2 decades. It has been a market that trades at a much cheaper multiple to New Zealand and to the United States. I guess if you step back and go, why is that? Why is Europe sort of been this underperforming market? Well, one is it has seen a number of sort of additional challenges over the last sort of 10 to 15 years than New Zealand or United States has seen. For example, there was a banking crisis not long after the financial crisis, where situations like the Greek debt problem, we've had countries like Spain and Italy, which have seen a number of debt problems. So in general, we've had lower growth in Europe. I think just from a general corporate perspective, the companies in Europe just have not been performing as strongly as you're seeing in New Zealand and the United States. One reason of that is possibly that that Europe's been sort of underrepresented in technology companies. So a lot of the growth in United States has been the fantastic expansion of technology businesses. which tend to grow at much higher rates than what you see in sort of more traditional industrial or utility type businesses. So it's sort of been an underperformer on that part. And it just hasn't really had this sort of multiple expansion that you've seen relative, that we've seen in New Zealand and United States. So what does that mean today? Well, on the one hand, I think we still see some risks in Europe. We've got inflation running quite high there at the moment. We've had interest rates starting to increase quite fast, and this is a region which hasn't had high interest rates for some time. So could we start to see some sort of stresses appear in say the banking sector there? We're not sure. On the other hand, we now have a much better position in terms of energy costs. We had the whole sort of gas explosion in gas prices in Europe and energy prices, which was a big concern. And so for this year, at least, we're seeing great performance in Europe, and it's a very cheap market. So I'd say we sort of have balanced views on Europe at the moment. We do think there will be a period at some stage where it really outperforms relative to the United States, but we're just a little bit cautious at the moment, given we want to kind of see how this economic situation continues to develop.
Righto, and so I mean, demographics is a key factor in there. Is that right, or what are the main other drivers that were pushing Europe to not perform over the last period, and has it?
Yeah,
are they lifting at all?
That's a good point. I mean, they have had a more aging population than we've seen in the United States. In general, the unemployment rates have been a little bit higher, and if you consider that you've got aging population who are excluded from that, and then you've also got higher unemployment in the rest of the country, that just sort of means your economic growth tends to be lower. I think. Everyone always tends to compare against the United States, where United States corporate sector has just been incredibly successful, not just over the last 10 to 15 years, but over the last really 60 or 70 years. And so not every developed market can grow at the level that the United States has over the last 70 years. So maybe we've been a little bit unfair sometimes trying to compare them to the United States. I think some of that maybe improves a little bit for Europe, but I don't think it's a problem that can be solved quickly. If you've got an aging population, that's just what you have. You can't change. And we know, for example, a place like Japan had fantastic returns during a economic expansion and bubble expansion period in the 70s and 80s. But since then, they've really struggled. Aging population, they had sort of disinflation appear in the market. And so Europe certainly hasn't been as troubled as that, but maybe there's somewhere in between sort of your Japan on the sort of the worst side and the United States on the best side.
So to round it out, I guess the broader question of, are we there yet? You mentioned we're roughly at fair value for a number of markets, and prices have obviously come back, but there's real opportunity there. How would you draw your conclusions?
Yeah, I don't think we can use a blanket rule in every market. This, I guess, is part of the reason we're trying to highlight the different markets here. So are we there yet in China? I would say with a reasonable amount of confidence that I think we are. I think the situation in China is starting to look much better. They're coming out of lockdowns. Their property sector is starting to recover. We know that economy generally benefits when commodity prices move higher, and commodity outlook is looking really good at the moment. They still have a little bit to work through. The economic growth outlook for 2023 was coming out a little bit low, a little bit softer than some expected. So it's not all smooth sailing, but you can buy that market at below average multiple levels on a market that is not really, which has been an underperformer relative to global markets for the last decade. And we expect, from a economic outlook overall is looking pretty favourable compared to the Northern Hemisphere and even New Zealand. So I would say we are there in China, and I think it's a great opportunity. Are we there in United States and New Zealand? Well, depends where you're looking at, how you sort of look at that. Yes, I think we're kind of there in terms of we've removed the excess valuations. Does that mean that we're guaranteed to make money over the next 12 months in that market? No. Does it mean that we are likely to avoid the worst case outcomes? I think yes. We're back at the long-term average levels, and the worst market sell-offs tend to happen from extremely high valuation levels. We just need to work through how we're going to get on top of this inflation situation, how high interest rates need to go. But can I invest in these markets with confidence on a 10 to 15-year horizon that I'm going to make annualized returns? Absolutely, because we're starting at a great starting point where earnings levels have come back to around about their trendline growth, and valuations have come back to around about the average historical levels.
Right, and so back to Jeremy Siegel's point, we can looking forward, that 7% real return compounding through time and doubling your money every 10 years is entirely valid and reasonable prospect from this point forward.
Absolutely. Well, I'm not smart enough or willing to go out and say that 200 years of stock market return data analysis is wrong, and that this is going to be the first period of 15-year negative returns. And I just think that's absolutely not the case. And I think trying to you've got so much on your side when you invest in the share market. You're investing in growing companies. You're investing in the best companies in the world. You're investing in assets which are incredibly resilient and adaptable. They change their cost structures. They change their operations to continue to try to make money. So, I'm just so comfortable that if you're taking a longer term view that you're going to make money investing in the share market.
All right, Andrew, thank you so much for joining us today. It's a great point to end on, and thank you for preparing these charts for everyone who's listening. I do encourage you to go and have a look through. They're enlightening, and they cover a wide range of periods, different viewpoints from which you can look at different share markets, and then they also do compare different markets to each other and against the MSCI, which is the global index. So you can understand the broader context of where we are today and whether, in fact, we are there yet or not. But now we've heard Andrew's view. Thank you.
Thanks, Stefan. Thanks, everyone.
Thank you, everyone.
This has been the Monday Call, brought to you by NZ Funds. New Zealand Funds Management Limited is the issuer of the NZ Funds KiwiSaver scheme, the NZ Funds Managed Superannuation Service, the NZ Funds Advised Portfolio Service, the NZ Funds Wealth Builder, and NZ Funds Income Generator. A product disclosure statement for each is available at nzfunds.co.nz. Past performance is not necessarily an indicator of future returns.